Waterfall City remains Attacq's crown jewel. The asset is largely responsible for the REIT's over 34% jump in distributable earnings, which has allowed the group to resume dividend payments at 50 cents per share. This full-year bounce back is also attributed to lower rental discounts to tenants, a reduction in debt, and the benefits of mass dividends. In the meantime, the group says while the outlook is cautious, it remains encouraging as it hits pause on mixed residential developments to focus on the further development of Waterfall City. Company CFO Raj Nana joins us now for a greater perspective of the performance. Raj, good afternoon to you. Thank you so much for your time.
Thanks for having me.
Raj, let's talk about the overall performance as CFO of the company. How are you feeling? I think I was quite encouraged to see a payout ratio of 80% on that dividend. I'm sure your investors are also beaming from that.
Absolutely. I think it's probably one of the big highlights of this year's results. The board taking the decision some time ago, confirming that the REIT status is still appropriate for Attacq, and hence us resuming the dividend this year. 50 cents representing an 80% payout ratio, and we've signaled to the market that the payout ratio as a policy is going to be between 75 and 85% going forward. And like I mentioned, 80% this year. I think hopefully shareholders will enjoy the distribution this year. We've also signaled to the market that we're expecting, or at least targeting, an 8 to 10% growth in the dividend for next year. So I think a good set of results this year, and hopefully some guidance that provides a positive outlook for the next year.
Now, Raj, internal inflation, I think, is something that you've definitely been contending with. When I was listening to the results presentation earlier, actually, I was listening to one of the executives speaking about how you've managed costs, you've managed timelines, and really it has been a positive year in terms of developments. Let's talk about how you've managed costs and the impact of inflation.
Absolutely. I think we're all, each one of us is struggling with inflation now in our own lives. Construction inflation has actually been a little bit more rampant than CPI, and we've seen major components of construction increase by sort of 30 to 40% over the last 18 months. And coupled with that is the challenges around supply chain. Just trying to secure certain elements of the construction is beginning to prove more and more difficult. I think that the year in review, we've managed to do that quite well, working with our contracting companies, securing supplies up front, paying for certain aspects of the construction up front, making sure that we can lock in prices. I think going forward going to be a little bit more challenging as this issue becomes a little bit more widespread. But within all of our developments, fortunately, we haven't run over budget or within project timelines, and managed to meet all of our sort of development yields. So I think it's been widely sort of kept in check, but I think going forward going to become a little bit more of a challenge. And the way we approach that is not fairly simple, but we effectively play open cards with our tenants looking for new developments. And what we target is what we call an open book type of transaction, where we disclose all of the costs, and the rental then is determined on the final costs. So if costs come in lower, rentals come in a little bit lower, and if costs rise slightly, then the rental is adjusted accordingly. And that way we try to mitigate the cost of the construction through that period.
Now, Raj, one of Attacq's biggest success stories is definitely Waterfall City, and that's just really been a good story. Let's talk about the occupancy rate that you're seeing there, but also how the impact of work from home and hybrid working has really impacted that development, which is fast becoming actually a central business district.
Absolutely. I think a lot's been said about flexible working arrangements and remote working over the last 18 months, and there's certainly still differing views. I think what we've experienced with our clients and tenants is that certainly the drive more recently has been for most employees to encourage their employees to come into the office, albeit between 3 and 4, 5 days a week. It's extremely important to maintain a company culture. I think it's difficult if you're a new employee, you've joined a company and you've never set foot into the office. You really don't understand how things are done in the office and sort of the purpose and the value structure of your employer if you're not on the ground. And so we're seeing more and more employers encourage those employees to come in. Certainly, anecdotally, We've seen utilization levels across all of our collaboration hubs, as we call it here in Waterfall City, pick up in the last sort of 6 to 12 months. And I think it's testimony to not just the change in employees' behaviors, but also we've seen new inquiries with regards to new offices. And I think that's testimony rather to the strength of Waterfall, like you say, as a central business district, really attracting both local tenants and clients, but we've also got a substantial, what we call an international client base. And I think 65% of our offices and logistics space comprising of multinational tenants, which is, I think, great. They're looking for safe, sustainable spaces, and Waterfall brings that for them.
And let's talk about the retention rates then, there with those strong tenants. I mean, you've got the likes of Deloitte, PwC, Accenture. That's some really strong tenants. Are you managing to retain them? And are you seeing new business? Are you seeing new entrants into that market?
Yeah, absolutely. So I think in terms of new entrants in the markets, I mean, we're busy with the transaction now with a large blue chip corporate looking to establish the new headquarters here in Waterfall City, just across the road from our own head office. And they're looking for about 5,000 square meters. And they obviously, they've got the whole of Gauteng at their disposal. Certainly, rentals in some of our peers and competitors' portfolios a lot less than what we provide here in Waterfall. But, they found something special here in Waterfall, and that's certainly attracted to them, and we're hopefully going to complete that transaction in the next couple of weeks. In terms of retaining some of the blue chip multinational tenants that we've got, absolutely. I think, if anything, we've seen clients look to upgrade their offices. So making sure that they've got the right audiovisual equipment, making sure that their employees are comfortable in the space at the office. And sometimes they trade that with slightly less space. So upon renewal, they're potentially looking for maybe 10 to 20% less space, but looking to invest in their kit out, making it as comfortable as possible for their employees.
All right, before I let you go, we must speak about the outlook for the business and just what you're expecting to see in the year ahead. Consumer confidence low, business confidence low, growth low, but still cautiously optimistic?
Absolutely. I think what COVID has taught us as a business is that the quality of our portfolio has been really resilient, and we've actually bounced back really strong post the COVID period. And so notwithstanding, rising inflation, rising interest rates, and low business confidence, I think we're very confident that in the next year we'll be able to deliver on the 8 to 10% growth. And, that's really testimony to the quality of the portfolio and what we're busy with in terms of new developments.
All right. That was Raj Nana, CFO of Attacq.